Welcome to the Deep Dive. Today, we're jumping straight into something really crucial for, well, anyone running a business or thinking about a new location.
Absolutely. We're talking about commercial leases.
Exactly. And specifically, how to get a decent deal, especially when the market feels pretty tough.
Yeah, it can definitely feel like an uphill climb. But finding favorable terms, it's less about luck and much more about having the right strategy and really understanding the dynamics.
Right. So think of this as your guide. We've looked closely at an article from Allies Commercial Realty. They're based in Indianapolis. And we've pulled out the key strategies. Our mission today. Simple. To give you the insights you need to make smart moves and hopefully land a lease that really works for your business, not against it.
Sounds good.
Okay, so let's dig in. In a challenging market, where do you even start to get, an advantage?
It really begins with seeing the whole playing field clearly. That means comprehensive market research. It's not just checking a box. It's fundamental.
Especially when things are tight, I imagine.
Exactly. You need a sharp focus, both on the sort of big picture economic trends, but also the very specific local dynamics of the area you're considering.
Okay. So the article mentioned looking at those wider economic trends, sure, but then really drilling down locally. What are the absolute key details someone needs for their target neighborhood?
You're hunting for those key indicators, like vacancy rates, how much space is just sitting empty. High vacancy can mean more leverage for you.
Okay.
Average asking rents give you a baseline. But then look at absorption rates.
Absorption rates, how quickly spaces are getting leased.
Precisely. How fast is available space being taken? A higher rate suggests strong demand, fewer options, and probably less room to negotiate.
Right.
And you also need to track the history. What have rental rates been doing over time for different property types in that specific submarket? Are they climbing, falling, stable? Identifying those trends helps you anticipate what might be next.
That makes a lot of sense. It's not just a snapshot of now, but understanding the recent past to sort of guess the future. And it gets even more specific, right? Like down to the actual street level.
Oh, absolutely. When you evaluate a specific district, you're looking at foot traffic, vehicle traffic. Is it busy? Quiet? Who are the neighbors?
Complementary businesses or direct competitors?
Exactly. How easy is it for customers and staff to get there? Are there any big infrastructure projects planned nearby, good or bad? And critically, zoning. Can your business actually operate legally in that spot? And keeping an eye on local tenant demand, who's moving in, who's moving out, that adds another layer.
Wow. It really sounds like you need to become a bit of a local market detective before you even look at specific listings. The article also mentioned external economic factors. What falls under that?
Yeah, think about things like inflation that affects overall cost, maybe rent, maybe operating expenses, interest rates. They can influence a landlord's ability or willingness to, say, invest in upgrades or offer TI allowances.
TI allowances, tenant improvements.
Right, money for customizing the space. Then there's employment trends, regional development. These signal growth or contraction, impacting demand for space. Even tracking tenant turnover in nearby buildings gives you context.
So pulling all that research together, it helps you find the right spot, obviously, but also negotiate better.
Absolutely. It empowers you. You can evaluate opportunities realistically, understand the risks, and negotiate from a position of, knowledge, not just guessing.
Okay, step one, become that mini market analyst. Understood. Now, the article also really pushed for getting professional help. Why is having a commercial real estate advisor or a tenant rep so important, especially when the market's tough?
Well, in a competitive market, these pros bring, frankly, invaluable expertise and current information. They know what's available, sometimes before it even hits the public listings.
Okay.
They have data on recent comparable leases, what deals actually closed for. And often they know the reputations of landlords and management companies. I mean, how much time can a business owner really spend gathering all that intel while running their business?
Yeah, probably not much. They're busy with their actual work.
Yeah.
So the rep isn't just finding places, they're advising throughout the whole thing.
Exactly. They guide you every step, site selection, crunching the numbers, property tours, reviewing proposals, even liaising with lawyers or designers if needed. Their experience helps you avoid costly mistakes someone new to this might easily make. And where they're really critical is in the negotiation. They're trained to spot, hidden risks in lease clauses, understand what's standard versus what's heavily favoring the landlord.
So they're really looking out for your interests, making sure you don't get tied into something bad.
Precisely. They understand the complex legal language and fight for terms that protect your bottom line. Think of them as your experienced navigator through a pretty high-stakes, complex journey.
Okay, that makes sense. Now let's shift to the potential pitfalls. The article mentions red flags and risky moves. What are some common mistakes businesses stumble into with commercial leases?
One of the biggest is focusing only on the base rent. That number looks appealing, right?
Sure, it's the headline figure.
But the total cost to occupy can be way higher once you add in CAM, common area maintenance fees, property taxes, insurance. These often aren't fixed, they can go up.
And CAM covers things like landscaping, security, building upkeep.
Exactly. And you need to know precisely what's included and how it's calculated. Is it fixed? Is it your share of the building's total cost? It's crucial detail.
Right, so that attractive rent might hide significant extra costs. What's another common mistake?
Not planning for the future. Your lease needs some flexibility. What if you grow? What if maybe you need less space? Not thinking about expansion needs or potential downsizing can lead to really expensive moves later or big operational headaches. Another risky move is choosing a spot just because it's cheap. You have to weigh that against visibility, customer access, zoning, who your neighbors are, future development nearby. A cheap space in the wrong place, that can cost you way more in lost opportunity.
That all tracks.
Yeah.
And I guess one of the biggest dangers is just not reading the lease properly.
Oh, absolutely. Rushing the lease review, or worse, skipping it. That's a huge gamble. These are binding legal contracts.
With serious obligations.
Exactly. Overlooking tricky clauses, hidden costs like uncapped pass-through expenses, rules that restrict how you use the space, or termination clauses that only benefit the landlord. These can cripple you financially later on.
Yeah, the lease document seems like where all the potential problems become real. The article also mentioned strategic misalignment. What's that about?
That's when the lease terms just don't fit your business goals. Like a really short lease if you're investing heavily in customizing the space, probably not ideal.
Right.
Or maybe the renewal options are terrible, or you have no right to sublease if your needs change. That lack of flexibility can trap you. The lease structure has to support your long-term strategy, not block it.
Okay, so avoid the pitfalls. Research, get help, read everything. Now let's talk negotiation, the actual deal making. What are the key things to really focus on at the table?
Well, negotiation goes way beyond just the rent number. As we said, you have to look at the total occupancy cost, taxes, insurance, utilities. Ask for a detailed breakdown. Understand how they're calculated, if there are caps on increases. Flexibility is also huge. Try to negotiate things like expansion rights if you think you'll grow, maybe even contraction clauses if your business fluctuates. And termination options, while you hope you don't need them, can be a vital safety net.
So building in options for the future, for uncertainty. What about the core terms of the lease itself?
Renewal options are key for stability. Locking in a rate or a clear process protects you from sudden market jumps later. Sublease and assignment rights. They give you an exit strategy if things change dramatically.
If you need to move or downsize unexpectedly.
Right. And tenant improvement allowances, the TI we mentioned, that's a big one if the space needs work. Get clear on who pays for what. And nail down maintenance responsibilities. Who fixes the HVAC? Who handles routine upkeep? Get it all spelled out clearly in the lease to avoid arguments later.
Get everything in writing. Seems obvious, but probably gets missed.
Absolutely critical. Every discussion, every agreement, no matter how small it seems, must be documented in the final lease. It protects everyone from misunderstandings. Vague language is where disputes start.
Now, you talked earlier about knowing the market. How does that knowledge specifically help when you're actually negotiating?
Okay, so understanding local vacancy rates, remember how much space is empty, rental trends, the supply-demand balance, this gives you a strong foundation.
How so?
Well, if vacancy is high in your target area, you likely have more leverage. More choices mean landlords might be more eager to deal.
All right.
If it's a tight market, low vacancy, the leverage shifts more to the landlord. Knowing this helps you set realistic expectations, and understanding broader economic factors helps too.
Like the interest rates you mentioned.
Yeah. Rising rates might make landlords less keen on big TI allowances. An economic slowdown might soften demand, giving tenants a bit more power on rent negotiations.
So it's about knowing the climate and how it affects everyone's motivations and options.
Exactly. When you grasp these market forces, you can ask smarter questions. You can push for terms that offer better protection against, say, future volatility. You're not just reacting, you're actively shaping the deal based on a real understanding of the market.
Makes sense. Beyond market knowledge, the article also emphasized due diligence. What exactly needs checking before signing on the dotted line?
Due diligence is your proactive defense against nasty surprises. You need to thoroughly check the property's physical condition.
Like the actual building systems?
Yes, HVAC, plumbing, electrical systems, are they up to code? Are they in good shape? You also need absolute confirmation on zoning that your intended use is permitted. No assumptions.
Okay.
Get a crystal clear picture of all costs, base rent, CHAM, maintenance, any potential upgrades you might be responsible for down the line. And reviewing the property's history past tenants, any disputes can sometimes reveal underlying issues.
It's like kicking the tires on a used car, but way more complex and with bigger stakes.
That's a good analogy. Comprehensive due diligence minimizes your risk enormously. It can even strengthen your negotiating position because you know exactly what you're dealing with.
Okay. Now, technology, it's everywhere. How can tech tools actually help in this whole commercial leasing process?
Technology can be a real game changer here, actually. There's software now that aggregates commercial real estate data, market analysis platforms. They give you instant access to vacancy rates, rent trends, local conditions. It's powerful information. Lease cost calculators are super helpful for comparing different options, apples to apples, looking at the total cost over the full term. Even things like negotiation checklists or performance tracking systems can keep you organized and ensure critical points aren't missed.
So using data to make smarter choices and just streamline the whole often complex process.
Exactly. These tools help you assess options thoroughly, compare costs accurately, spot trends, and ultimately make decisions based on data, not just gut feeling. That usually leads to better terms and fewer risks.
Lastly, this might sound a bit softer, but the article really stressed building strong relationships. How does being personable or having good connections actually help secure a lease?
Yeah, it might seem less tangible, but in a tough market, trust and good relationships can be incredibly valuable.
How so?
Well, tenants who build solid professional relationships with landlords and brokers, they might get wind of opportunities others don't. A reputation for being reliable, communicative, cooperative, that can lead to more favorable terms.
Maybe the landlord is more willing to invest in the build-out.
Potentially, yes. Or offer more flexibility later on, like options for expansion or allowing certain modifications. It's about being seen as a desirable tenant.
So it's not just about this one deal, but maybe laying the groundwork for a positive long-term situation.
Precisely. Investing in clear communication, showing you're collaborative, building a good track record, it positions your business well. It frames the relationship as more of a potential partnership than just a simple transaction. That can pay dividends.
This has been incredibly useful. So wrapping it all up, it really seems like navigating a tough commercial lease market successfully isn't about luck at all.
Not really, no.
It's about being strategic, doing your homework, getting that market knowledge, actively participating, and really understanding how all these pieces fit together.
That sums it up perfectly. When you understand and use these strategies, you approach the whole process with much more confidence. You're not just accepting terms, you're shaping them. And that significantly boosts your chances of getting a lease that genuinely helps your business succeed long term.
Right. And maybe just to leave everyone thinking, consider all these elements we've talked about, the research, the rep, the negotiation points, due diligence, relationships. Which one feels like the most critical priority for your specific business needs right now, given the market you're in? And what other questions does this deep dive spark for you about your next commercial lease move? Thanks for exploring this with us.
Get in touch with Allies Commercial Realty at info@alliescommercialrealty.com to find your ally in commercial real estate.